To make any kind of predictions on that, you have to look back at what happened in 2007 when MiFID I was introduced. You introduced competition between trading venues, so the national exchanges were open for competition. And all of a sudden you ended up with a market that was hugely fragmented. You have fungible instrument trading on multiple exchanges, and basically what was considered a good idea from the beginning, that it would drive down the transaction cost due to competition, ended up costing in slippage. So that's when you started talking about total cost of transaction. That was not around before MiFID I. Brokers operated largely unregulated trading venues called BCNs, or broker crossing networks, which in essence is what we know as a dark pool right now. And a dark pool is basically takes away the liquidity from the lit order book. So all of a sudden you ended up with a market share of 10 to 15% trading outside the regulated markets. And with that, the liquidity was seen as basically evaporating. That affected client behavior as well. So all of a sudden you couldn't get a block done in the lit market. So clients were less prone to block trades and started slicing orders. Basically the average trade size just declined to a minimum of what it used to be pre-MiFID. They started using algorithms, execution algorithms, basically slicing an order over the day. That was done pre-MiFID as well, but not on this scale. And benchmarking became extremely interesting for clients. They measured against every possible benchmark, and even if the order instruction was to do 10,000 shares of a certain stock at this level, they started looking at VWAP and other parameters that had nothing to do with the instruction. So a lot of over benchmarking came around as well. And that in turn basically had to do with a new market participant that emerged through MiFID I, and that was the high frequency trader. When you have multiple venues, you have different times to reach these destinations. And that could be taken advantage of if you had superior technology. You could basically front run an order going to one destination. You can see that it was on its way there and take out the liquidity on another destination because you had a faster way to that market. And high frequency traders were said to add liquidity because it's a new participant, it's a new player in the market. So the reasoning was that it should add to liquidity since a new entrance do that. But instead you have the possibility of them front running the orders. So another argument would be that they may supply liquidity, but that liquidity is toxic. So you had that discussion as well. To a large extent, all these effects were unexpected by the legislators, at least in scope, and that was basically what prompted MiFID II. The term expect the unexpected is remarkably accurate when we speak about this. So MiFID II is expanding the regulation into new asset classes, and also taking it a bit further by updating the best execution policy, for instance, to be more far-reaching, basically. So fixed income, OTC trading, derivatives, they have 10 years of catch-up to do if you compare to equities trading. And they will have to adopt best execution policies to be able to show transparency, to be able to do pre-trade risks and all these technical factors that accompany this legislation. This means that the OMS-EMS solution have to cover new asset classes. It will have to cover new instrument types. It will have to include new functionality with regards to transparency, to reporting, to unbundling, which is going to be a huge part of MiFID II. The fact that you can pay someone for research and then pay another counterparty for executing on that research. As with the previous trends, the workflow is going to be the ultimate driver. So once the workflow is set, okay, these are the MiFID II requirements, and how do we adapt to that? And once we have figured that out, we can make some sort of prediction on what's going to happen to the OMS-EMS. It has to include a lot of functionality that you previously could shop for by having a standalone product, and also it has to be deep, and that I think is going to be the tricky part. Because if you add, let's say you add TCA to your existing system environment, so you can analyze an order. But what if that order analysis comes out bad? It makes you look bad. You have executed this poorly. So if you don't accompany a TCA or order analysis with a state-of-the-art execution capabilities, there's really no use of doing the analysis in the first place. So everything included in the system needs to be top-notch, starting with execution, obviously.